Alright, today is Wednesday, December 29th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and here it is, in focus. Let's talk about the last warning, why the everything bubble will come down crashing in 2022. Let's start by this, the Buffett indicator versus the 10-year Treasury yield. As you can see, the Buffett indicator on top and the 10-year yield below. The Buffett indicator follows the left axis, the 10-year yield follows the right axis. And as you can see, every single time, the Buffett indicator reached these readings, it was followed by a market crash. So we are due for a market crash. Why didn't the crash happen? We go back in history, every time the Buffett indicator reaches these readings and we start to see the 10-year yield moving higher, this is your leading indicator, the warning that the crash is about to happen every single time. The difference this time around is the fact that the 10-year Treasury yield is not normal. It is pretty much at the bottom reading. It is yielding less than 2% and hence inciting the TINA argument. There is no alternative, and therefore you have to be long stocks regardless of the valuations. In the past, every time the Buffett indicator reached these kind of readings, there was an alternative the moment the 10-year yield started to move higher. It was yielding 5, 6, 7%, even double digits at some point, and therefore there was an alternative to move away from overvalued stocks to bonds and other assets. This time around, the TINA argument says, what are you going to do? Dump your stocks? Yes, they're overvalued, but you're going to dump your stocks and go to bonds? The 10-year yield is yielding below 2%. The risk versus reward says, stay long stocks. Here's the problem though. I always thought TINA is stupid and trash. I mean, even back in high school, TINA was a tramp. But all joking aside, the TINA argument will start to fade away in 2022 because the 10-year yield will start to move higher. And it doesn't need to move higher by much. Just a little move higher will serve as a leading indicator that the market crash is about to happen. When we look at the chart of the 10-year yield, for example, this is a monthly chart. It has been on a downtrend since the Volcker approach, when legendary Fed Chairman Paul Volcker raised interest rates aggressively in the late 70s to combat inflation. When inflation came down, so did the 10-year Treasury yield, and the rest of interest rates continued to go down from that point on. So we have been on a downtrend for decades now. That downward trend was about to be broken to the upside, and we were about to see the massive surge in interest rates, specifically in the 10-year yield, as the Fed started to normalize its policies under new Fed chairman at the time, Jerome Powell. When Jerome Powell started to raise interest rates back in 2018, we all remember the reaction of the stock market. The stock market went down 20% in an instant. It was a flash crash right away. And at that time, the argument was, why would you raise interest rates, Mr. Powell, and normalize the policy when we don't have inflation? What is the wisdom here behind raising interest rates? And then came the Powell pivot. And at the time, Mr. Powell succumbed to the pressures from the Trump administration and Wall Street, arguing, why would you raise interest rates when there is no inflation problem? Powell listened and pivoted, and hence interest rates went down. And that just extended the mania for a little while. And then came the COVID-19 crisis, the crash, and the Fed doubled down in their interest rates policies, the loose money policies, by cutting interest rates further. What are we seeing right now? The 10-year Treasury yield is moving higher. It appears to be bottoming, and it wants to reverse the multi-decade downward trend. Here's another way to look at the chart of the 10-year yield. What we're seeing right now is a formation of a cup and handle, which is known by technical analysts as a bullish formation, meaning that this chart will start to trend upward from this point on. But of course, the chart of the 10-year will not move higher unless the Fed actually starts raising interest rates. And if market expectations become solid that the Fed is indeed serious about raising interest rates and normalizing the monetary policy. Now, why would this be a problem, by the way? You might say, what is the big deal here? If the 10-year yield went higher to 2%, to 3%, even 4%, who cares? We had these levels before, and the stock market performed just okay. Here's the problem. The valuations, the S&P 500 right now, from a price to sales ratio, is at all-time highs. We have never seen these kind of valuations before, and therefore, the slightest increase in interest rates will bring down this house of cards crashing. Likewise, when we look at the price to sales ratio for the tech-heavy NASDAQ, we are almost at an all-time high reading, and therefore the slightest increase in interest rates will bring down these valuations metrics crashing, and that will come hand in hand with a crash in the stock market. Here's another thing to keep in mind. So far this year, we have yet to have a correction above 5%, which is a normal behavior of any market in any given year. To have a 5% plus correction. We have yet to have one. Why? The answer is because the retail investors crowd continue to buy the dip over and over and over again, believing that every dip is an opportunity to buy and the stock market will trade higher over time. Never mind the valuations, never mind the risks in normalizing the monetary policy, all of that doesn't matter for now to the retail investors crowd. We're seeing trillions of dollars being pumped inside the market, and this is keeping the market afloat for now, even though we're seeing individual stocks completely collapsing. But the indices are holding because the big caps, the investors' favorite names, are still holding. We're talking about Apple, we're talking about Microsoft, Google, Facebook, Tesla, Nvidia. Market crashes don't happen unless one important condition is met first. What is that condition? The answer is the drawdown of excess liquidity in the system, meaning, for now, the consumers, the mom and pop investors, are flush with cash, even though they have already exhausted stage number 1 of spending, meaning the stimmies. The stimmies are now gone, and the child tax credit payments are also gone. So no more stimmies. Stage number 2 of spending is savings. And we already know that savings rates are now reading below the pre-pandemic readings, meaning consumers have already exhausted their savings. Stage number 3 of spending is racking up credit card debt. And we're seeing credit card debt surging higher again. What happens after that? The consumer is out of liquidity. What will support the growth in corporate earnings when the spending and purchasing power of consumers are already exhausted? Another important element here, when the excess liquidity in the pockets of mom and pops and the consumer is already drawn down, who's going to buy the dip in the stock market? And therefore, two important elements here are sucking that excess liquidity from the pockets of mom and pops and the consumer. Number one, their purchasing habits. They're spending like crazy. They exhausted stimmies, exhausted savings, and now they're racking up credit card debt. Element number two, the stock market is acting as a vacuum machine, sucking that liquidity away from consumers and mom and pop investors as the so-called FOMO rally continues to happen. Meaning, you have regular retail investors saying, oh, I'm going to sit on cash and wait for the crash before I buy. Well, the crash is not happening so far, and all of what they see is the dips are being bought and the market continues to make all-time highs. This is a very seductive action by the market, and hence the FOMO rally. And these investors who are sitting on the sidelines waiting for a better opportunity to buy will be lured in to buy the stock market at these top evaluations. We have seen this exact scenario happen back in 1929 when retail investors and mom and pops and the consumers started spending like crazy and spending every penny they have to buy stocks, even going as far as borrowing on margin to buy stocks, all in believing that the stock market will continue to go higher, and who cares about valuations and fundamentals? That doesn't matter at all, until it did. And hence, the market acted back then as a vacuum machine, sucking that wealth away, that excess liquidity away from mom and pops, the poor, the middle class, and handing that wealth away to the rich who dumps at the top, booking their profits, creating the market crash, and then the mom and pops start to scramble as the market continues to go down to book their profits or losses, and that exacerbated the crash in 1929. And then, of course, they went to the banks and they started to draw out cash, and that led to the Great Depression. So one element of a market crash is already being satisfied, drawing away the excess liquidity from the hands of mom and pops, the average retail investor, be it by spending or by luring them and trapping them in the so-called FOMO rally in the stock market. And then when the rich starts to pull the trigger, crashing the market, causing job losses, as corporations become defensive by firing their recent hirings to reduce their input costs, and as these people start to lose their jobs, guess what? They're out of liquidity. Matter of fact, they're indebted now because they have credit card debt from the spending, and the only reserve available is the stock market. Well, now they're down, they're losing money, but they have to book the losses because this is the only liquidity reserve available to them, and therefore exacerbating the crash. Now, why would the rich pull the trigger and start selling and dumping in an aggressive manner? That leads us to element number two that has yet to be satisfied, which is raising interest rates by the Fed and tightening the monetary policy. Why would the Fed do that? The answer is it all revolves around inflation. You see, inflation so far has been good for corporate America, and the reason is consumers are still flush with cash, and corporations are able to jack up prices higher and therefore expanding their margins. The problem is, as Dr. Friedman said, the beginning stages of inflation, just like alcoholism, is good. But then as you get deeper into the inflation crisis, it becomes a problem. And this is exactly what we're getting to right now, as the forecast for operating margins in the S&P 500 starts to stall. And here's the problem with inflation, folks. Many economists, even seasoned economists, don't even understand what inflation is. A lot of them got it wrong. They said inflation will not happen. We've been in this deflationary period for a long time, and it's impossible for inflation to rise higher in a sustainable way. Well, guess what? They were wrong, including the Fed officials who insisted that inflation will be transitory. And we now know it is not transitory. Here are two videos that you need to watch to understand what's going on with inflation. Number one, a video that I made recently about the 1970s inflation crisis. Number two, another video that I made about a month ago discussing the role of monetary policy in the creation of inflation and why inflation is a self-sustainable phenomenon once it's born. What does that mean? There are limitations, severe limitations regarding the fiscal policy in controlling inflation. And we went over examples in the 1970s, the price controls by Nixon, whip inflation now by Ford, the austerity measures by Carter. All of these failed. They might have tamed inflation in a transitory manner, but inflation came back bigger and stronger and in a more aggressive and vicious manner. Inflation only went down after Paul Volcker took the helm at the Federal Reserve and started raising interest rates aggressively. Because when it comes to inflation, it's like a tornado. The trick is, once you see the cone, it is time to act. Meaning the Federal Reserve has to act by tightening the monetary policy before the tornado lands. And the cone was out there. We talked about this back in April. The time has come for the Fed to start tightening the monetary policy. So you have all of this misinformation out there from the Wall Streeters, the financial media, Federal Reserve officials, economists, and some of the most popular YouTubers with hundreds of thousands of subscribers, even millions of subscribers, who've been saying inflation is going to be transitory, prepare for disinflation, we have disinflationary factors in the economy, inflation will never happen. Guess what? They've been wrong all along, and they continue to beat on the same drum, even though inflation is the highest in 40 years. And this is exactly what we predicted in this channel back in January of this year, ahead of the game. Yet you have these geniuses online beating the drum that we have all of these disinflationary factors. Inflation will never happen. Inflation is already here. Hello. And then they say, oh, look at the prices of TV, for example. Prices of TVs went down over time. China is disinflationary factor. Technology is disinflationary. Amazon is disinflationary. They have absolutely no clue what they're talking about. Take, for example, the prices of TVs. They went higher by almost 8% year over year, according to the CPI. We talk about China as a disinflation factor. Yes, it used to be, not anymore, because wages are rising in China, and we have shipping and logistical hurdles in China adding to the cost, and therefore China is becoming more inflationary than disinflationary. Likewise, Amazon used to be disinflationary, not anymore, because Amazon now has a monopoly over commerce, and they have the luxury of pushing wages higher to attract the talent. And this is inflationary in nature. Once Amazon raised wages to $15 an hour, all of a sudden Walmart went higher, Target went higher. All the other retailers started to hike wages higher because it is a competitive environment between Amazon and them. Employees will choose the retailer that pays the most, and hence Amazon is now inflationary. What about technology? Technology used to be disinflationary, and certain elements of technology remains disinflationary. But think about the role of technology in our lives. The social media element, for example, we have a whole generation of younger people and not so younger people now making income from playing Twitch, from posting on Instagram, on OnlyFans, and other social media platforms. And hence, they're making income using the new avenues of technology, and they're not working in the traditional avenues of employment, creating a labor shortage. A labor shortage is inflationary in nature because it pushes wages higher. When we talk about inflation, inflation is a self-sustainable phenomenon once it's born. Think of the tornado. When the tornado lands, it's over. You got no control over it whatsoever. You just have to sit and watch the damage happen right before your eyes. The only proven remedy from history, at least what we know for now, is the Volcker approach of tightening the monetary policy aggressively and raising interest rates sharply to control the demand element in the economy, to crush the demand and therefore bring inflation down. But so long as the loose money policy is here, so long as the accommodative policy by the Fed is here, demand will never die. It will continue to grow higher and higher and higher, pushing inflation higher and higher and higher. But do you think the geniuses over at Wall Street, the economists, the superstar YouTubers will tell you any of that? Of course not. Another element of the self-sustainability of inflation is inflation expectations. When you have wages and oil prices going higher, this is an input cost increase for corporations and goods manufacturers, goods providers. They have to pass that extra cost to the end consumer. Corporations, any responsible leader of a corporation is not going to wait for inflation to be transitory. They have to be ahead of the game, and therefore they raise prices higher according to the increase of input prices, oil prices, wages, materials, etc. And then it becomes a vicious cycle, a spiraling event of inflation going higher without the need of the monetary policy to be accommodative anymore. It becomes a cycle that feeds within itself to become larger and larger and larger. Take, for example, the prices of lumber. They surged significantly higher earlier this year, and then they crashed. And the Fed and their allies, the so-called transitory team, rejoiced. Look at lumber. And soon enough, rental car prices will also go down. Home prices will also go down. Just look at lumber. They were wrong. Dead wrong. Yes, lumber crashed, but lumber is rising again. Matter of fact, since lumber prices bottomed, they're up 150%, and they continue to rise higher and higher and higher. And soon enough, they will overtake the prior high. This is the vicious nature of inflation. It is self-sustainable. You can beat it artificially, it will go down and then it will pop higher again until and unless the Fed starts tightening the monetary policy aggressively. Look at natural gas prices. Yes, they went down, but they're still up 150% since they bottomed back in 2020. And my prediction is natural gas prices will curl back higher again, just like we saw with lumber. Again, this is the nature of inflation. There is no such thing as a transitory inflation. What about cotton prices? Look at this. We saw dips, we saw corrections, and everybody said, okay, cotton prices are going to go down. Hence, inflation is transitory, but they continue to get bought over and over and over again. And cotton prices since the bottom are up over 132%. Is this inflationary or disinflationary? The answer is it is inflationary. You're gonna pay more for cotton. You're gonna pay more for apparel prices. Whether the goods are manufactured in China, Vietnam, doesn't matter. The input cost of cotton is surging higher. We'll look at coffee prices exploding higher. These are the highest relative coffee prices that we have ever seen. What about oats prices? Yes, they went down slightly from the top, but since the bottom, since pre-pandemic levels, oat prices are up over 175%. Is this inflationary or disinflationary? And yes, oats prices could go down in a correction, but that dip will be bought and you will see higher prices again. This is, once again, the nature of inflation. Soybeans. We had the nice head and shoulder. Soybean prices went down. Everybody started to say, wait. Inflation is going to be transitory. Look at soybean prices. Well, they're curling back higher again. Wheat prices. They continue to move higher, significantly so. Canola prices to the moon. Pre-pandemic, they were trading below 500. Canola prices are now over 1,000, more than doubled in price. Is this inflationary or disinflationary? Likewise, live cattle prices are the highest that we've seen in many years. Look at copper prices, more than doubled the pre-pandemic prices. And you could blame it on the virus, the shutdowns, but look at what's going on. We had cycles of reopening, shutting down, cases going higher, cases going down. It didn't matter. Copper prices continued to go higher. Why? Because the source of inflation is not the virus. It is not the shutdowns. It is not the supply chain woes. The source of inflation has been always the monetary policy. When you print trillions of dollars out of thin air, flooding the system with excess liquidity that is not needed, that liquidity will go on to chase commodities, pushing these prices higher, and thus the self-sustainability of inflation. What about egg prices? They peaked in March, and everybody said, oh, look at eggs. They went down. Inflation is transitory. Well, guess what? They're going higher again. Look at oil prices. This is crude oil Brent. It topped at the former high of 2018 around 86.70. Now go back to 2018. Brent prices peaked around October of 2018. What was happening back then? The Fed was raising interest rates and therefore oil prices went down. This is a proof that the remedy to cure inflation is raising interest rates significantly higher. Fast forward to today. What's going on here? They pulled the cute trick of releasing supplies from the Strategic Petroleum Reserve and the new variant. And yes, oil prices took a hit. They went down, but look what's going on right now. They're moving higher again. Since the bottom, crude oil prices are up over 20%. They made a higher low, and they're eyeing 86.70 to crack that resistance level once and for all. And when that happens, you're going to see the stampede in buying oil, and you will see the explosion. The massive rally in oil prices, perhaps reaching 100. Is this inflationary or disinflationary? I think the answer is clear. And you might say, what about the supply? The supply is abundant. Well, OPEC controls the supply, and OPEC has no interest whatsoever in increasing supply. Take, for example, a country like Saudi Arabia. This is their last chance to diversify away from oil. A dying commodity, it will die at some point. You think they're not going to take advantage of higher oil prices to diversify their economy? Think again. And you might say, what about the domestic supply? We have a lot of oil in this country. The problem is drilling is becoming more expensive. The shale oil boom is dead. No bank, no lender out there is willing to finance shale oil drilling. Matter of fact, according to the Dallas Fed Index, the input cost for oil services has reached record high. So yes, in theory, higher oil prices should incentivize domestic producers to start pumping oil. The problem is cost is also surging higher, giving low-cost producers like OPEC countries the advantage here. Even if prices go to 85, 90, 100, the cost will continue to climb for shale oil producers, and the banks are not lending anymore. What does that mean? Forget about the supply coming to the market. Oil prices will continue to move higher, absent of the Fed jacking interest rates aggressively higher. And the energy crisis has spiraling impacts. For example, higher energy costs will shut down factories that are producing aluminum in Europe. And we're seeing factories in Spain, for example, halting production for 2 years because energy prices are soaring higher. What do you think halting the production of aluminum for 2 years will do to aluminum prices? It will push them higher, and therefore aluminum prices, the everything metal, by the way, if these prices climb higher, is this inflationary or disinflationary? And folks, this is becoming a worldwide phenomenon. Not just limited to the States or the European Union, even in South America. Inflation is soaring, pushing wages higher. We got readings from Colombia today. The wages are surging higher. And as wages surge higher, guess what? The expectations for a more aggressive policy from the monetary policy in Colombia is moving higher. They're betting the Colombian central bank will double the key rate in 1 year, meaning interest rates will move higher. We already know that the Russian bank, for example, the Russian central bank, the Bank of Russia, has been jacking interest rates aggressively higher, and they have yet to control inflation. They have a long way to go in hiking interest rates. And you and I know commodities are dollarized, and therefore it doesn't matter what the Bank of Russia does. If the Federal Reserve of the United States of America doesn't cut the loose monetary policy by raising interest rates, inflation will continue to rise higher in Russia, even though the Bank of Russia is raising interest rates higher. It all comes down at the lap of the Federal Reserve. And of course, inflation is also becoming a political problem as consumers face surging costs, from rents to food to utilities, to gas prices. Matter of fact, the majority of Americans at some point believed that inflation was due to the reopening elements from the virus. Fast forward, now the majority of Americans believe that the Biden administration policies are responsible for inflation, not the reopening elements. Of course, the majority of the population is not aware of the role of the Federal Reserve in creating inflation, and they're going to blame it on whoever is in the White House right now. Inflation is becoming a major problem for the Biden administration. The majority of Americans disapprove of Biden's handling of inflation. 67% of Americans disapprove. Do you think the Biden administration wants higher inflation or lower inflation heading into the 2022 elections. Yes, everybody believes in the separation between the White House and the Federal Reserve. That's bullshit, of course. We know, historically speaking, the White House and the Federal Reserve coordinate on policies all the time. And of course, we have geniuses who say, you know what? Perhaps we don't need to raise interest rates. Perhaps all we need is price controls. Wow. Somebody please give the writer of this article, Isabella Weber, the link of my YouTube channel, specifically the video that I made about the 1970s, because price controls failed in the 1970s. Nixon tried it, Ford tried it, Carter tried it, they all failed. The only remedy is tightening the monetary policy. The next recession, here is when the everything bubble will burst. And this is according to Murray Sabrin, who warned against the Fed's inflationary policies in 1976. Now he thinks the next bust is around the corner. My fearless forecast, he says, is inflation accelerates in 2022, then the public outcry over skyrocketing prices and the media reports highlighting how prices are decimating the average family's purchasing power may cause the Biden administration to impose wage price controls, as President Nixon did in 1971 to take the sting out of inflation before his 1972 re-election campaign. Biden could use an executive order if Congress doesn't give him statutory authority to impose price controls. He could do that, but that's not going to work in controlling inflation. It might dip inflation down for a little while. Inflation will come back stronger and more aggressive than before because the source of inflation is always the monetary policy. So here is the conclusion, folks. Condition number one for the market crash is being met. The market is acting as a vacuum machine to suck away the wealth from the poor and the middle class. They're also spending like crazy and racking debt. This is condition number one. Condition number two is the Fed raising interest rates. The doubters will say condition number two will never happen because the Fed will never raise interest rates. Look at the level of debt. The zombie companies, they will collapse the entire global economy. The Fed is between a rock and a hard place. Choice number one, yes, they could raise interest rates and risk a global crash. Number two, they could do nothing, as these doubters believe, and lead to hyperinflation. But many of these doubters, the level of arrogance is unbelievable. They actually believe that inflation will go down. They still believe in the transitory argument of inflation. We have proven it is not. Just look at lumber prices, for example. So the question here is, will the Fed choose route number one, raising interest rates and see what happens, and risk a market crash that could lead to an economic crash? Or will the Fed wait and hold, hoping that transitory will work, and risk hyperinflation or perhaps stagflation in this country and even globally? Let's entertain the doubters. Let's say the Fed is not going to raise interest rates, and it's going to remain accommodative because they care about your portfolio, right? Let's say, hypothetically speaking, that happens. Well, this will lead to hyperinflation, perhaps stagflation, and then the Fed will have to be even more aggressive than before in tightening the monetary policy. And that will produce 1,000,000% a severe market crash that will perhaps lead to another Great Depression. The longer they wait, the riskier the outcome. And therefore, the Fed has no other choice but to start raising interest rates and normalizing the monetary policy. And if that happens, you go back to the Buffett indicator. The crash will happen 1,000,000%. This is according to the Atlanta Fed. The probability of a 25 basis points rate cut is collapsing, and this is for March 2022. On the other hand, the probability of a 25 basis point rate hike is surging significantly higher, indicating that the Fed will start raising interest rates as soon as March. The bottom line is tick-tock, tick-tock, it is coming. And folks, with that positive outlook out of the way, let's move on to cover the market today, starting with the performance, and here we go. The Dow Industrial Average closing in the green by 90.42 points, or a gain of 0.25%, also known as a 0.25%. The Nasdaq, the divergence continues here. The Nasdaq is down 15.51 points, or a decline of 0.10%. The S&P 500 closing in the green by 6.71 points, or a gain of 0.14%. Notice the nasty candle by the end of the day. That could be a leading indicator, but we are still in the seasonality that favors the path of least resistance higher. Moving on to the sector's performance, leading the pack at number one, capturing the gold medal, REITs. At number two for the silver, defensives. At number three for the bronze, healthcare. The laggards of the day led by energy energy, communication services, and cyclicals. What about the advance to decline ratios? For the NYSE, 53% advancing versus 44% declining. The NASDAQ, only 37% advancing versus 59% declining. The NASDAQ is only being held by the big caps. It is just a matter of time before the big caps start to fall apart. Moving on to futures. What's going on here? We have muted activities for the energy market today. Crude oil, Brent, WTI, gasoline, they're all gaining, be it modest gains. We have a down day here for natural gas and heating oil prices. Moving on to softs. What's going on here? Lumber prices continue to gain, be it modestly today. Likewise, we saw gains led by cotton, coffee, cocoa, and sugar futures. The only decliner in softs is OJ, down big, over 2%. What about metals? A down day across the board, modest down day for gold, copper, but about 1% downside for silver, platinum, and palladium. Moving on to meats, gains across the board led by feeder cattle futures, lean hogs, and live cattle. What about grains? Muted activities for soybeans, soybean meal down modestly, soybean oil up modestly, corn, wheat, rough rice, no major moves here, but look at canola exploding higher by almost 6% today alone. Likewise, oats are down by about 1%. Moving on to the big casino, the options market. What's going on here? As you can see, these seasonalities taking place. The volume is down big today in the options market, but yet the hottest table remains Apple at number one with almost 1 million contracts traded today. About 71% of those were calls. And at number two, Tesla, the souffle, with about 650,000 contracts traded today. About 58% of those were calls. And at number three, Nvidia, with a little over 350,000 contracts traded today, about 64% of those were calls. And pay attention to the implied volatility, folks. The implied volatility is historically high for the big caps and the names leading the market higher. What does that mean? We're getting closer to a top in these names. When I look at the IV percentage, for example, which measures the current implied volatility versus the volatility for the year. Apple, for example, the current volatility is above 61% of the readings for the year. Tesla, 63%. Nvidia gets even crazier, 77%, AMD 88%. As the IV percentage climbs higher, it becomes an indicator that the stock is topping. Look no further than the performance of AMD today as an example. Now, pay attention to this. You might look at Alibaba, for example, and you see the IV percentage is above 90% of the days of the year. Be careful here, because in names that are trending down, the IV percentage, the higher it is, it means that the pain is not over yet. So for stocks that are climbing higher, the higher the IV percentage, the closer to the top we are. For stocks that are crashing, the higher the implied volatility, the further away we are the bottom. Moving on to the unusual activities that took place in the options market today, starting with the ticker IWM for the Russell 2000. We have a spread here, a call spread. They bought the 239 calls and they sold the 244. The expiration date, February 18th, with the expectations that the Russell 2000, the IWM, will climb higher by more than 7.5% by then, but not by more than 10%. They paid about $1.30 a piece for the 239 calls that they bought, and they received in credit 70 cents a piece from selling the 244 calls. All in all, reducing the entry cost to about 60 cents a piece. All in all, spending about $600,000 for this trade. We have another spread here for the ticker DKNG, DraftKings. It's a call spread. They're buying the 29 calls and they're selling the 31 calls, all for the expiration date January 7th, with expectations that DraftKings could climb higher or rebound higher, shall we say, by more than 10%, but not more than 17%. They paid about 40 cents a piece for buying the 29 calls, and they received about 16 cents a piece from selling the 31 calls. All in all, reducing the entry cost to about 25 cents a piece and spending $200,000 for this trade. What about the trade for the ticker FUTU, FUTU? They're buying puts here, a Chinese name. They're buying the 36 puts for the expiration date January 7th, with the expectations that the name could drop down by more than 5.5% by then. They paid about 2.5 cents a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker PINS, Pinterest? They're buying the dip here by buying the 38 calls, the expiration date January 21st, with the expectations that the name could pop higher by more than 6% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $600,000. And what about the trade for the ticker TSP for Too Simple? This is a startup for self-driving and other hype, of course. The name is down big year to date, but they're buying the dip here, betting for a rebound by buying the 35 calls for the expiration date January 21st, with the expectations that the name could rebound higher by more than 12% by then, and they paid about $1.75 a piece to enter this trade. All in all, spending about $900,000. And lastly, at the bottom of the table, what about the ticker XRT for the retail ETF? They're buying more puts here, betting for more downside for the XRT. They bought the 84 puts for the expiration date January 21st, with the expectations that the name could drop down by more than 6.5% by then. They paid about 75 cents a piece to enter this trade. All in all, spending about $375,000. Moving on to the heat map analysis, what's going on here? The volume is down, no major action whatsoever here, but they're dumping a lot of the high-risk names, the high multiple names, because the 10-year yield popped higher today, and therefore the technology sector of the market is trading down. But what is working here? Value, for example, Cisco, IBM, Lam Research, even within technology, Micron, for example, another value name, is outperforming today. You also have the classic defensives, the derivatives paying stocks, be it big pharma, be it industrials, be it materials, be it utilities, REITs, or even consumer defensives, the consumer staples. They're all trading higher today. The theme is defensive, folks. The breadth is bad in the market. So you might see all-time highs on the S&P 500, all-time highs in the Dow Jones, record high. Yet when you dig down, the story is oddly different. Moving on to the charts analysis, starting with SPY, 30 minutes chart. What's going on here? We had a series of bull flags popping higher, and now we're consolidating here. You could argue it's a bear flag. It is a weaker formation of a bear flag. The closing candle was not good, but the bottom line is, what the chart is doing right now is working out these overbought conditions. And as you can see, this is a 30 minutes chart, of course. When you look at the RSI, we're not overbought anymore on the 30 minutes. Here's the problem. When we switch to the daily, we are still overbought. So more work has to be done here. The bullish scenario, of course, is more consolidation, because more consolidation means a process of gathering energy before resuming the move higher. Now, let's say the SPY pulls back tomorrow. We're looking for 470 as support. We're way above that right now. We're at all-time highs. So we're not looking for a particular level of resistance, a particular number. We're looking for a reversal formation. What does that mean? A reversal candle on the daily. And for that, we have to move on to the daily chart for the continuous contract on the SPY. What's going on here? Do we have a reversal candle? The answer is no. All what we have is consolidation for now. Indecision. A lack of volume. And a lack of volume means the path of least resistance is higher. So you're seeing some buying here. Perhaps the majority of buying has been already exhausted, and now we're waiting for what? Either more buying is going to come, or more sellers will show up once the seasonality is over. The momentum indicators are getting stronger on low volume, of course, and the higher they go, the riskier it becomes, because the more overbought readings you get in longer dated charts, the more significant the overbought conditions become. They're not as significant on the 30, for example. When we get to the hourly, the daily, the weekly, then the pullback becomes inevitable. And here is a 30 minutes chart for the Qs, the Nasdaq. What's going on here? Once again, a process of consolidation to work out these overbought conditions. So far, the overbought conditions have been fixed on the 30 minutes chart, not in the hourly and the longer dated charts. And therefore, we're identifying 397 as the center of gravity in this chart. It pulled the chart like a magnet on the way up, and it will also act like a magnet to pull the chart down when the pullback happens. What about a daily chart for the continuous contract on the Nasdaq? What's going on here? We broke above the descending line of resistance. For now, we have to revisit the same line and retest it as support. If the retest happens, and we see a rebound higher, this will be bullish. If the retest happens and there is a failure, it will be a bearish signal. Notice that the volume is recovering higher on the way down. This is not a good signal for the bulls, even though the momentum indicators reversed the negative divergence and they're now strengthening. We're not going to move here until we see the retest of the descending sloping line of resistance, now supposedly support first. What about the IWM, the Russell 2000? A 30 minutes chart. What's going on here? We had a bull flag formation playing out before the reversal happened, forming a bear flag, and the bear flag played to the downside today. But again, under low volume, the path of least resistance is higher. So they bought the dip in the IWM, and now they're grinding against 223 as resistance. So far, they have failed to close above that number. Doesn't mean that the IWM has to trade down tomorrow, but you give it another day and another failure to climb above 223, then the inevitable will happen, and the chart will flush down to the next support of 218. Moving on to the Dixie, the dollar index, what's going on here? We finally have a daily closing below 96. We're now waiting for a weekly closing below 96. This will be the confirmation. Another flush down will confirm the negative divergence on the RSI and the MACD, and if that happens, it will reaffirm our outlook that precious metals should be bought at this point. And here's the chart of gold. What's going on here? It was a bad candle earlier in the day because gold went down, but they bought the dip right away. You gotta remember this. Gold has two enemies. Number one, the US dollar. Number two, the 10-year Treasury yield. The dollar traded down today, and that was the reason behind the move higher, buying the dip in gold. The problem is we did not see the massive pop higher in gold and more buying because the 10-year yield moved higher, impulsively so. Now at some point this will reverse because you and I know that back in the 1970s, yields and gold went higher hand in hand. But since then, it has been an inverse relationship between yields and gold. At some point, that could reverse depending on the psyche and the mentality of market participants. Are they viewing gold as an inflation hedge or not? The answer is, so far this year, they're not. Perhaps as inflation is in the earlier stages, the best hedge is individual stocks in specific sectors of the market like energy, materials, defensives, etc. Likewise, commodities are a good hedge against inflation in the earlier stages. Bitcoin also worked as a hedge, at least so far. When we get to the later stages of inflation, the ugly stages, perhaps market participants will start buying gold as the ultimate inflation hedge, and when that happens, the 10-year yield will cease to be an enemy of gold. But for now, here it is, the chart of the 10-year, a massive pop higher today, even though we are within the seasonality, the low volume, even in the bond market. But perhaps this is a leading indicator for trouble to come in 2022, because you have the NASDAQ dilemma, the high multiple, high growth, tech kind of names. When the yield on the 10-year was trading down, predicting a recession, tech stocks did not like that. But we also know when the 10-year yield moved higher, impulsively so, above 1.6, 1.7, the NASDAQ and the technology names did not like that either, because higher interest rates will cut the multiples in the NASDAQ, the high growth, the high mania, the high multiple kind of names. For now, for this chart, we are already above the important number, 1.5, comfortably so. The momentum indicators are getting stronger. We are now at the resistance of 1.55%. The chart might pull down from that point on, yet a weekly closing above 1.5% will confirm that the 10-year yield will move higher. On the other hand, bond prices, the TLT, will move down. And here's a chart for the TLT, a weekly chart, losing 149 yet again. And if the TLT closes below 149 for the week, then we have a confirmation. Yields will pop higher, the TLT will go down, so trade accordingly. Higher yields are good for banks, but they're not good for tech. And here's a 4 hours chart for the VIX. What's going on here? Again, the seasonality is crushing the VIX and pushing the indices higher. But look at the behavior of the chart from the MACD perspective, for example. It is building that energy for another pop higher. Sooner or later, the VIX will pop another leg higher once the volume comes back into the market. What does that mean? The drop in the VIX right now, we're below 17, folks. That means it is a golden opportunity to buy hedges, meaning put options on the individual names that you have in your portfolio. You never know what's going to happen next year. We might start with a crash right away. You take the advantage of a lower VIX, meaning lower premiums for those put options. When the VIX pops higher, The premiums for put options also move higher. You don't want to wait till the VIX pops above 20 again or 30 before you start to hedge. You want to hedge now. Here's a daily chart for Apple. What's going on here? It is behaving exactly as we anticipated, facing the resistance from the sloping line. This is a bullish formation from a candlestick pattern, and you have to read the psychology here. They want to reach $3 trillion. They want to have the headline. They will do anything that it takes to pump Apple to read $3 trillion. They want to see the headline, and that headline will be the top right there and then. And then we go down. The support will be 172.4. If that doesn't work, then closing the gap at 165.32. Perhaps at that time, it will coincide with the upper line from the trading channel Apple has been trading within for over a year now. Moving on to a 30-minute chart for Tesla. What's going on here? It is consolidating in a bearish formation, by the way, from a 30 minutes perspective at least, but it is hugging the important number, 1,090.5. If there is a pull down in Tesla, perhaps to remove some overbought conditions on the shorter term charts, then 995 will act as support, and then we'll take it from there. Because if 995 fails, then we have a massive gap below. And notice this, Elon Musk came out and said he's almost done dumping, eliciting a reaction in the stock via short covering, and the stock moved higher. What does he do next? He starts dumping again. Where is the SEC? If any other executive gets engaged in this kind of behavior, the SEC will drop the hammer on them. Not Elon, because Elon is above the law. He has the cult following, and he can single-handedly bully the SEC and bully Gary Gensler. And you and I know that on top of being in a coma, Gary Gensler is also a pussy. Or, an eyeball. You see, the female followership for this channel is increasing. We don't want to upset them. The days of the locker room talk with the boys, these days are going to be gone in 2022. Moving on to tulips, what's going on here? Not a good look, not touching it. And the reason is when you have a bullish formation like we had before, a saucer bottom plus a bull flag, and that doesn't manifest in a pop higher, and instead the stock, or in this case Bitcoin, flushes down, this is an ominous signal, and it says there were folks holding options with the expiration date this Friday, expecting a pop in Bitcoin. It didn't happen, and as they got closer to expiration, they decided to dump right away, flushing Bitcoin down. So you're not buying Bitcoin here until after Friday's expiration, and preferably after retesting 42,000 as support. And lastly, what about AMC? What's going on here? Nothing new, still consolidating between the support of 26 and the resistance of 32. So far, so good until you break 26. The weekly closing is important. A closing above 26 keeps the hope alive. A closing below 26, goodbye. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have an important reading in the weekly jobless claims, and we say important because the Fed made it important. Jerome Powell says, I'm waiting for maximum employment before I start raising interest rates. If we have yet another reading that the Pokemon variant did not dent hiring and we're seeing claims down, and this is yet another indicator, another piece of evidence that we're getting closer to maximum employment and raising interest rates higher, which the market will not like. We also have the Chicago PMI, another important inflation indicator, so we'll be awaiting these readings. But for now, folks, I'm done here. This is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow.